If you're a first-time home buyer in Canada, you're so lucky. You have access to a money-making tool that the rest of us can't use or benefit from. The new FHSA. Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about the FHSA. We'll go over what the FHSA is, the two key benefits of the FHSA, and how FHSAs work, including the criteria for opening it, FHSA participation room, as well as withdrawals and closing your account. At the end of the video, I'm going to share 3 tips to help you maximize your savings using the FHSA. So let's jump right in. First of all, what is the FHSA? FHSA stands for First Home Savings Account. It's basically a type of bank account that you set up through your financial institution. You can have your institution manage it for you, or you can set up a self-directed FHSA, which you manage yourself on a platform like Questrade. The program began on April 1, 2023. The main goal of an FHSA is to help first-time home buyers save up to $40,000 for a down payment on a qualifying home. You might be wondering why you should set up an FHSA if you can simply put money aside in a regular savings account. There are 2 key benefits to an FHSA. 1. The money you contribute allows you to reduce your income taxes, which is very similar to how RRSPs work. We'll dive into more detail in a second. 2. Any investment income you make within the FHSA, including interest, dividends, and capital gains, is tax-exempt, just like in a TFSA. If you want more information on RRSPs or TFSAs, I've linked my videos about those registered accounts in the description box below. So, how exactly does the FHSA work? For starters, you need to be a first-time home buyer to open an FHSA. We'll go over what that means a little later. Next, you make contributions to your FHSA, in other words, you put money into your FHSA account. How much you can contribute depends on your participation room, which I'll go over shortly. The amount that you contribute can be deducted from your net income when filing your taxes, so it reduces the amount of taxes you need to pay. Meanwhile, the money inside your FHSA earns investment income and you don't pay taxes on that either. Let's look at a quick example to see how FHSA contributions reduce your income taxes. Let's say you earned $60,000 this year and you made an $8,000 contribution to your FHSA. You can deduct that $8,000 from your income, bringing it down to $52,000. This reduces your taxes from almost $7,000 to just over $5,500, for a tax savings of more than $1,400. Keep in mind that this doesn't even take into consideration provincial taxes. Someone living in Quebec, for example, would have saved a total of $2,947 in federal and provincial taxes combined, or about 37% of the $8,000 contribution. Okay, so, how much money can you put in your FHSA? Everyone gets the same participation room, determined by the CRA. $8,000 per year, up to a lifetime limit of $40,000. Your participation room starts in the year you open the account, even if you don't contribute to your FHSA right away. This is why it's important to fill out Schedule 15 when filing your taxes for the year you opened your FHSA. This lets the CRA note that you opened the account, so they can begin counting your FHSA participation room. The formula for calculating next year's participation room is the following: $8,000 plus unused FHSA participation room at the end of the current year, up to a maximum of $8,000. Notice the unused participation room that you can carry forward is maxed at $8,000. This means that you can never carry forward more than 1 year's worth of participation room. Let's look at 2 examples. First, this is Amanda. She opened her FHSA in 2024 and hasn't made any contributions yet. Her participation room for 2025 is as follows: $8,000. Plus, her unused participation room from 2024, $8,000. For a total of $16,000. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Alright, now for our second example. This is Jessica. She opened her FHSA last year, in 2023, but still hasn't made any contributions as of 2024. Her participation room for 2025 is as follows: $8,000. Plus, her unused participation room from 2023 and 2024, but up to a maximum of $8,000, so that's $8,000 again, rather than $16,000. For a grand total of $16,000, just like Amanda. Two more important points about participation room, before we dive into what a first-time homebuyer is. First, the CRA will charge you a tax of 1% per month if you overcontribute to your FHSA. That's why it's important not to go over the $8,000 annual limit, or the $40,000 lifetime limit. Second, income earned within your FHSA doesn't lower your participation room. If your participation room is $8,000, and you earn $500 of interest within your FHSA, you can still contribute $8,000, rather than only $7,500. Now that we understand what the FHSA is, and how participation room works, not everyone can open an FHSA. There are actually 3 conditions that must be met. Number 1, you must be between 18 and 71 years old to open an FHSA. Number 2, you must be a Canadian resident. And, number 3, you must be a first-time home buyer. So, who is considered to be a first-time home buyer? It's someone who didn't live in a qualifying home as their principal residence, that they or their partner owned, at any time in the current calendar year, or the preceding 4 calendar years. In simple terms, you can't have lived in a house that you or your partner owns in the last 5 years. It's important to note here that a first-time home buyer, for the purpose of opening an FHSA, is different than a first-time home buyer, for the purpose of withdrawing from the FHSA. Let's look at that next. To be able to withdraw the funds tax-free, you must meet all of the following conditions. You must be a first-time home buyer for the purposes of making a withdrawal, meaning that you didn't live in a qualifying home as your principal residence, that you owned, at any time in the current calendar year, except the 30 days immediately before the withdrawal, or at any time in the preceding 4 calendar years. Notice the part about your partner owning the home is no longer a criteria, and there is now a 30-day grace period in regards to living in the home. Next, you must have a written agreement to buy the home, with an acquisition date before October 1st of the year following the date of the withdrawal. You can't have bought the home more than 30 days before making the withdrawal. You must be a Canadian resident from the moment of your first withdrawal until the actual acquisition of the home. You have to occupy the home within 1 year after buying it. Finally, you need to fill out Form RC 725 and give it to your FHSA issuer. If you don't meet every single one of these criteria, the withdrawal will be added to your income and taxed like any other income you earn. Lastly, how and when do you need to close your FHSA? You need to close your FHSA before December 31st of the year in which the earliest of these events occurs. The year following your first qualifying withdrawal from your FHSA. The year you turn 71 years old. Or, the 15th anniversary of opening your first FHSA. Before closing your FHSA, you should first remove any funds left in the account. You can do this by simply making a withdrawal, but it will be taxable. The better option is to do a direct transfer of the funds to your RRSP or RRIF, which is tax-free and does not impact your RRSP deduction room. You must contact your FHSA issuer and follow their instructions to close the account. Finally, I'd like to share 3 tips to help you maximize your savings using the FHSA. First, as long as you meet the criteria, it's worth opening an FHSA even if you don't plan on buying a home anytime soon. There are 2 main reasons for this. 1, it will allow you to deduct your FHSA contributions from your net income so that you can save on taxes immediately. This is particularly useful if you've already maxed out your RRSP deduction room. 2, the FHSA can stay open for 15 years, so that's plenty of time to earn investment income tax-free, just like in a TFSA. If you decide to buy a home along the way, the funds will be there for you. And if you never buy a home, you can simply transfer the money to your RRSP, tax-free, and without affecting your RRSP contribution room. My second tip is to combine withdrawals via the home buyer's plan, with those from your FHSA, allowing you to make a bigger down payment on the home. You can withdraw up to $60,000 from your RRSP with the home buyer's plan. Combined with the $40,000 lifetime limit of the FHSA, that's potentially $100,000 for your down payment. This means that you'll be paying more principal upfront, so less interest overall on your mortgage. Last, combine your withdrawals with your partners for the same home. This applies if you're buying a home with another person, such as your spouse. You can both use your FHSA and the home buyer's plan for the same house, as long as you each meet all of the required criteria for both plans. This would allow you to withdraw up to $200,000 towards a home, tax-free. That is, $60,000 each, via the home buyer's plan, plus $40,000 each from your FHSAs. I'll be making a video all about the home buyer's plan in the future, so stay tuned for that. So there you have it. We discussed what the FHSA is, the 2 key benefits of the FHSA, and how FHSAs work, including the criteria for opening it, FHSA participation room, as well as withdrawals, and closing your account. I also shared 3 important tips that will help you save money using the FHSA. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.